Hey guys, Brett Alegre-Wood, Chairman of YPC Group and author of the best-selling book, The 3+1 Plan. Okay, so today the question is, how much leverage should I use to build my portfolio? And it's one of my webinar questions, and effectively it's actually a really good question because it's not something that most people think about. Because if we were honest, most people are starting off in investing. You know, they may have their own home, they may have one buy-to-let property which may be in the home they lived in, and for most people starting out, it's not a big issue. You look for the maximum mortgage you can get, okay? Because you're trying to take that, use as little money as possible and keep that money in your account that you've got. So, at that level, it's a pretty simple answer, okay? So most people will go for the maximum amount. And that, depending on the country you're in, could be anywhere from 65% to 95%, okay? But realistically, if we're talking about building a portfolio, all right, and at the end of the day, we all have to, okay? If you can watch other videos that I've done on how many properties you need, and you can read the book, The 3+1 Plan, but realistically, there's a number of factors that affect the answer to the question, okay? So let's have a look at each of these. Now, my general answer would be 60 to 80% loan to value, okay? So how much leverage? Well, you should be putting 40, to 20% in for each property, okay? And there's a range of factors. So let's just have a look at them each in turn, because I think if you understand the factors, you start to get a sense for how I build people's portfolios and why I put certain restrictions in, why we place certain provisions off to the side, and why we use mortgage cost averaging. In other words, we jack up the mortgage rate a bit on the cash flow worksheets to make sure you've got some tolerances in there, okay? So look, the first one is the experience. Obviously, if you've got very little experience, then that will tend to move you down, from the higher loan to values to the lower loan to values, okay? Now, not so much on your first one. Your first one, as you're starting off investing, that's going to be much more about getting the maximum mortgage. But as you start to build, because if you're talking now you've got 2 properties or 5 properties or 10 properties or 50 properties, okay, then you need to change things. Because if you're still at 50 properties and you're taking 80-85% mortgages, well, I can tell you, you're going to be in for a shock. Because if you look at, I've got in my latest book that's coming out, I've got 5 stories of 5 different gurus, okay, all of whom stood on stage and went, we're wonderful, we built this up, 150 properties in 2 years, 18 million worth in 3 years, all these sort of stories. And when I looked at them, actually at the height of the market, it looked good, looked impressive. But actually I was sitting there going, that's dangerous, because I can see they've used massive amounts of leverage. They've got very little equity in those properties. So realistically, they may have lots of properties, a big ego attached, but the bank owns most of them, all right? As we build bigger, we've got to lower our loan to value, okay? In other words, we've got to get more equity in that property, okay? Now, the reason I say 60% is because, quite simply, at 60%, I think whatever the shocks in the marketplace are, whatever the market cycle's doing, whatever interest rates are doing, 60% is going to get you a cash flow positive property through the whole market cycle, okay? As well as that, prices aren't necessarily going to drop more than 40%, okay? Now this assumes that you've bought well and you haven't bought overpriced and you haven't inflated the value and done all these sort of ridiculous, cash back and all that sort of stuff. If you've done that, then it's a different story. You're probably never going to be at 60 for a long time. Okay, so that's the reason I choose 60, because pretty much you're insulated from all the shocks, even if the worst happens. Now if you think about it, in the UK in particular, let's say, about 20% prices dropped. In some areas a bit more, it could be 40%, but 40% is pretty much the extent, that's the maximum extent to a drop really that we've seen, all right? So even at that level, you still would have been able to sell your property if you had to, okay? Now obviously we don't want to, but if you had to, you can do that. And that's why that sort of 60% barrier is there as the minimum, okay? Up to 80%, and look, if it's 85 or even 95, it's to say, in Australia or some of the places you can get 95%. When you're first starting out, fine, all right? Now, experience. So first point is experience. If you've highly experienced, you know what you're doing, you know what all the risk factors are, you've taken them all into account, then fine, okay? Go for your high loan to values, go for your 80%, okay? Now, the other factor is age, all right? If you're young, you can afford to take a bit more risk. All right, so obviously you can borrow more, so the higher loan to values are fine. If you're getting older and say 60 plus, well, in fact, probably 55 plus now, you need to start considering that if you're at your whole portfolio, hopefully you've got a portfolio by now, is it 80%? You need to perhaps look at dropping that down. And all that means is rather than taking money out, rather than spending money, you either need to sell some property and pay some of the other mortgages off, or you need to just sit around and let them sit for a while and let the capital values grow. All right? Now obviously it's market dependent and all that sort of thing. But effectively, you know, the older you are, the lower your loan to value should be, the more equity you have, because you don't want to take as much risk. Because if the worst happens, it all falls over, you haven't got a lot of time to rebuild back up. All right? So the older you are, the less risk you want to deleverage effectively. Okay? So number of properties makes a big difference. That's the third factor. So with experience, with age, number of properties. If you've got one property, that's not too much of a problem. You can factor in all the provisions and increases in interest rates, drops in prices, all these sort of things. Okay? If you've got 5 properties, now it's a very different story, because a 1% raise in interest rates on that portfolio could mean a significant increase in your mortgages. So now you need to think of things like not only your leverage in terms of deleveraging a bit more, so moving from that 80 down towards that 60, okay, but also you need to factor in, you know, if interest rates increase, so you might want to put away a bigger provision, okay, or you might want to fix half your mortgages and let the other ones variable, so you get, you know, that balance. All right. So experience, age, number of properties, stage of cycle. Okay. Look, there are times in the cycle when property is sitting around doing nothing. All right. In those times, okay, and especially if interest rates are going up, you don't want to be highly leveraged. The lower the leverage, the better. So if the prices are shooting up, then you can probably leverage a bit more. But you've got to remember that stop sign in my property cycle, and if you haven't seen that, just watch the video on the property cycle and it'll explain that all to you, all right? But it's fine if the market's shooting up to perhaps go more towards that 80, whereas the market's sitting stagnant, you want to get down towards that 60. And ideally, while it's still going up, you want to start to deleverage towards the end of that. So use the first half of it to build your capital, build your number of property, build your portfolio, but then towards the end of it, you need to deleverage, because if you do that, then as interest rates increase, you're okay. All right. So experience, age, number of properties, income. Okay. If you've got, and this is not necessarily a question about income, it's more about disposable income. All right. Because we all know the more money you earn, the more money you tend to spend, and if a lot of those spending is fixed expenditure, all right. In other words, it's not discretionary. Okay. Now, if it's discretionary, fine, but we're talking about disposable income. How much of effectively interest rates going up, or things like that happening, can I actually provide for? Now, if you've got a low income, you probably want to go more towards that 60. If you're on high disposable income, then actually you can move towards more that 80, because you can afford to have interest rates go up by 1% or 2% or 3% or whatever it is, okay, and still sit there and hold the portfolio throughout. Because at the end of the day, this is a game of buying and holding. If you think you're going to make huge money out of buying and selling and buying and selling and buying and selling, all that's going to happen is you're going to move from one job to another job. And most people, when they become a professional investor or a full-time investor, they think that that means they have to work full-time. Yeah? So all they're doing, they're trading one job for another. Yeah? Maybe a bit more freedom, a bit more ego. You can sit around the dinner table and talk about how great it is. But in actual fact, for me, property investment doesn't take a lot of time. And that's how I would say that most of the people I speak to, most of the clients I deal with, they don't want to become full-time property investors. In fact, becoming a full-time property investor would probably be the worst thing for them, because you're at home twiddling your thumbs. Eventually, your wife or your husband kicks you out of the house and says, go get a job. Because it's not that glamorous, it's not that wonderful, okay? Doing full-time investment. Passive investment, now that's a different story, because then I can choose to do whatever I want with my life while my portfolio is in the background working away for me. Okay, so the final factor is the risk appetite. Look, if you're a type of person that stresses out, when someone goes boo, or worries about things a lot, then perhaps you want to move more towards that 60. If you're someone who, brazenly just wants to go out and conquer the earth, well then you can move maybe towards that 80. But remember, risk appetite, okay, is not actually a symbol of a good portfolio or that sort of thing. So that final one, and I left that final because I don't want you to take that just because you're prepared to take the risk, doesn't mean you should. Doesn't mean that it's going to come off. doesn't mean that it's going to be a safe thing to do. All the previous ones, they are true effects on that 60 to 80%. The final one is much more a bit of ego, all right? Because actually, you know, the risk appetite. Now look, I'm not saying that's a bad thing, but what I'm saying is just because you think you can go out there and buy 10 properties, you know, and there's no, you know, you're not worried about the risk, you know, you still sleep at night, all that, doesn't mean you should, okay? The other 5 ones, okay, the experience, the age, the number of properties, and the stage of cycle, and the income, okay, those 5 things, they're the key. The risk appetite is the bit of the red herring in there, okay, for the 6th one. But guys, hopefully that gives you a bit of an idea of the sort of factors that we deal with when we're talking about portfolio management, because all of those come into play, all right? And when you factor in all of them, actually you can build a large portfolio safely, securely, not having to worry about interest rates rising, you know, prices dropping, all these sort of things. You can hold the portfolio throughout with minimal stress, because after all, property investment comes down to one test, all right? And I call it the sleep test, yeah? If you can't go to bed, sleep a full night, wake up feeling refreshed, then perhaps, you know, there's something you need to change about your portfolio. If you can, fantastic. You know, you're probably building your portfolio at the right pace, you know, with the right leverage and that sort of thing. Unless the risk appetite and the, you know, the ego side of the risk appetite gets involved, in which case you think you're indestructible, all right? The interesting thing is, at one stage in the cycle, when prices are shooting up, you can be forgiven for thinking that you are indestructible. But what you've got to realize, and this is the key to building a portfolio, is making sure that even though times are good now, you're looking onto the horizon and working out where the market's going and making decisions now whilst you can still make the decisions and can structure the portfolio so that when the horizon does, you know, appear to reality and becomes the present, that actually whatever that is, you can face it and still sleep at night. Okay guys, have a great day and live with passion.